So I'm a little less polished than Dave here, okay? I'm going to use this board, and I'm going to draw on it. I'm going to talk to you guys. And really, we're just going to have a conversation about real estate today. So sound like a thing to do, I guess. I'll try to keep it short so we can get some food in us, I think. That's what everybody's agenda is, too, a little bit. So anyways, who knows, who here in this room is buying or selling a home or knows somebody, friend, family, that's doing that within the next 3 to 5 years? Probably most of you should because it's the average is about 5 years turnover for selling homes. So this information will be very relevant to you guys because we obviously faced a serious real estate market downturn, right? Back in 2008. Now it's not been going well over this past decade. All right, so people are wondering what's going to happen. There's a lot of economists out there that are saying, well, because interest rates are going to go up, that real estate is going to see another crash tank and all this stuff. You guys heard that in the news at all? Any of that? Okay. I'm going to be a little bit contrarian to that. All right. I'm going to demonstrate to you guys why that's probably not going to happen. All right. And why, for a hard asset, it's something that you guys can look forward to seeing some values increase in your home. Now, if you're looking at investing in real estate, of course, you'll always talk to Rob or your financial advisor about that, because make sure you're not making a crazy decision and that fits with your full picture, right? But you're about to find out, though, that real estate is really a good place, even if it's just the home that you own, to have your money. And now, or over the next year or so, is better than 5 years from now or 10 years from now. All right? Real estate's very confusing to a lot of economists because it doesn't follow the same rules as other economic sectors, right? But luckily, it's really easy to follow if you pay attention to certain things. And I'm not very smart, so I'm really good at paying attention to the things that you need to pay attention to, okay? So, you guys ever heard of this? Supply and demand, all right? That's it, okay? Now, people are going to talk about interest rates, employment rates, all kinds of stuff. And when you look historically, this is the only thing you really need to look at. To know whether your house price is going to go up or down, you just need to look at supply or demand. Real estate is a hard asset, okay? So it's a thing. We think of it like a market because the prices can fluctuate. It can fluctuate wildly in a neighborhood. And even the way you list your house could determine whether or not you get 10% more or less for that property. But it's a thing. It's a hard asset. And supply and demand is what dictates that. Okay, so when you have more vacancies, all right, that means that you got more buyers, okay, than what you have of houses, which means you have an under supply, okay? When that happens, your prices go up, right? So price goes up, all right? And consequently, you got less vacancies, all right? And that means you have more buyers in the marketplace than what you have available homes. That means that there's this was oversupply, undersupply. You have an undersupply then, right? Which means that your prices then, this is prices go more, this is prices go up. Anyway, so you guys get the idea, okay? More buyers.
Should be less buyers.
Yeah.
Less buyers.
Less. There. Woo! All right. All right. Less buyers, more houses. All right. Then that means, so anyways, yeah, less buyers, more houses, prices lower, okay? More buyers, under supply, prices go up. It is really that simple, all right? Regardless of interest rates and other things. And I'm going to show you guys how historically, when you look at the 70s, see, everyone's thinking of 2006. You remember in the 70s? Remember what happened to real estate then? Remember when, interest rates went up to 21% back then? And yet, from 1970 to 80, that was the highest boom that we saw in the real estate market in the entire century, last century. Weird, huh? Think interest rates is going to affect. And the reality is, we print money, right or wrong, we print money like crazy people. And unfortunately, we borrow money like crazy people too if we don't allow it, right? So people will pay the interest rate when the time comes. They just will. They might not refi their house, but when it comes to actually buying the hard asset, they're going to buy it. They got to move, they got to move. You know, they're going to pay more money. So let's look at this little chart here. All right. So I like to draw little charts. I like to keep it real simple because, in my opinion, if I can't keep it simple, then probably don't know what I'm talking about. All right. During Reagan, 82 to 90, we saw a 100% increase in real estate, okay? And then we did see a little bit of a recession or dip in real estate from 90 to 95. It was not gigantic, but it was substantial enough. And then it started to pick up from 95 to 98 again at about 30% increase, you know what I mean, between that. And then what happened, 200% increase up to 2006, all right? So that's, you guys are very familiar. Then 2008 happened. Things started to actually go down in 2006. Then we really saw a big dip, okay? And that takes us to where we're at now. And since 2012 to 2016 is what we're getting into, we've seen again, conservatively, houses are going back up again, right? We've seen that, okay? And now people are getting back out from underwater and all that stuff. Well, what some economists are predicting is a 4 to 7 times of an increase, 400 to 700% increase over the next decade or more, okay? And I'm going to demonstrate, as you know, I'm going to tell you guys why that is, okay? You can look at the foreclosure market to help determine some of this stuff. All right, so what happened here? We didn't have any foreclosures. Demand was greater than supply, so prices doubled, okay? Things got a little bit overblown. We had some foreclosures right around here. So, you know, that's sort of caused this little thing. Then they started selling off the foreclosures and getting rid of all of those, and then things started going up again, okay? So it's been about 8 years. 8 years is what you're seeing in these boom markets. Once the foreclosures sell off, you see an 8-year run-up in the market. Supply demand, right? So when you have a bunch of low-price houses out in the market, more houses for sale than buyers, prices go down. But when those foreclosures are out of the marketplace, what happens? They go up again, right? And so we can expect, we had this current recession last a little bit longer, but we can expect that to pick up tremendously. And the reason why is we can look at this too. Here's another, you guys like my charts though? Pretty good, right? All right, so we've seen every 30 to 40 years major busts in the economy, and then we got to do something to pick that up, right? So 1890 was something having to do with McKinley and gold standard and stuff that I don't remember because I wasn't born back then. Then we had 1930. Don't remember this, but I read a lot about it. That was what? Great Depression, right? So that was another big, huge bust here. 1970, I don't know, something about OPEC and different things, right? Happened back then, okay? And then, we don't want to confuse this with another chart here. So then we had 2000 to about 2010, all right? Tech bubble, all that stuff, okay? So these are our major, you know, fluctuations, all right? So what happened was, about here, you know, about 35 different government programs overinflated the real estate markets. Over here, what happened was what? You guys remember? What standard were we on for currency that Nixon said no more?
Gold.
Right. We got rid of the gold standard and we started printing money. Like, we're printing money. You know, we print like $3.3 billion a day in money right now, just so you guys know. So do you guys think inflation's going to go up? Yeah, probably, right? That's why I said 100% certainty. $3.3 billion a day. Anyway, so that's what they did back then, though. They were under 10 million a day in 1970, and then by the end of the decade, they were into like 20 million a day that they were printing. once they got off the gold standard. And that artificially inflated things, okay? And so here, we've been dropping interest rates for like 30 years. We can't drop them anymore. So what are we trying to do now? Stimulus packages, you know, and printing more money, all right? And so this is going to cause an inflation problem, which is why it was so good to hear Dave's presentation on how you can diversify your asset classes, because you're going to need to, all right, in a high inflation environment. But real estate does fairly well when there's inflation. It's a hard asset, right? Just like gold, silver, some of these other things. Okay, so if you're printing over $3 billion a day, that pretty much guarantees inflation. This is bad for the economy, but again, it's good for the real estate markets. So what we're looking at, I'll draw you another little chart here. Phases of the real estate market. This is your long-term occupancy, okay? Averages, all right? What happens after recovery? Phase 1 is recovery, okay? And so you're in the recovery phase here, and there's no new construction going on in the recovery phase. They've all pulled that out. Do you guys remember when there's no new construction happening, like 08, 09, 08? Well, but what's happened though since 2012? New construction, right? Yeah, and so what happens is now we have what's called the expansion, all right? And that goes on for a while. That's where you have declining vacancies and new construction. Houses are being built again, okay? And then you have what happens is they keep building it, but you see a pullback, and that's when you have this hyper supply. So too much supply, demand goes down, then you see an increase in vacancies, and then and so you see another recession in our market. Okay, so yeah, so here's what's happening now. All right, you know, foreclosures are dying down again. All right, so 2016, we're going to see our foreclosure inventory is going to be almost over with. We're not going to have any more. All right. So baby boomers, and a lot of this again is the conversation, just kind of going off. You'll hear news about baby boomers and they're not buying houses. You guys heard that? Yeah, because what they're doing is they're taking the numbers of new house purchases. They didn't take into account the 500,000 of foreclosures and short sales that have been getting sold last year, 2014, 2013. Do you see what I'm saying? We're running out. We don't have any more left. Other than a few odds and ends, 2016 early, we're going to be done with foreclosures. It's 500,000 houses. No new construction was built, right? So for a long time. We got to keep up with population when you're building houses. Population grows about 2.75 million, right, a year. Okay, so yeah, 2.75 million a year people. You got about you want to build about 2 people for every 1 house. That's kind of how it works. So 2.5 for every 1. So 2.75 billion people. You should be million. You should be building over 1 million houses a year, but we haven't been. So we should have built 8 million houses since 2006, a little over that. We've only built 4 million houses. So what are you guys seeing? Supply and demand problem, right? So we're short 4 million. We've lost the foreclosure market. So what we're going to see then is there's going to be buyers out there and not enough houses. That's what I'm seeing every day when I'm listing property. It's like I'm getting multiple offers. I got all this stuff happening. You know what I mean? And that is going to continue for a while, especially as inflation increases. You know, and so especially as that happens, we're just going to continue to see this boom happen. So, all right. I'm going to draw my last chart. So, we know it's going to go up because we have a supply and demand issue. All right. But how much? You know, how much are we doing? What can we account for inflation? All right. Well, let's look at this. 2014. In 2014 we had $1.23 trillion in circulations. All right. the banks held on to 2 trillion and corporations held on to 6 trillion because interest rates are so low. It's not sound investment, you know what I mean, to loan that money out and get 8% or 10% on your money if the interest rates are higher. Interest rates are below 5%, you know what I mean? They're holding this, plus they're nervous, all right? And that's what was happening back then. Well, 2015, 2016, the foreclosures sell off. We'll be done with that next year. And what do you think is going to happen? Dave Washington already talked about this. Raising interest, right? Oh, people aren't going to borrow money anymore because they're raising interest. No. Here's what's actually going to happen. Okay, so 2016 onward, okay, this money is going to be injected into the marketplace. You guys understand that? Because they're going to start wanting to loan this money out again because they want a return, all right? And they're rising interest rates now, so now they can get more on that investment. Now that it becomes an investment. So you got about $7 to $8 trillion. It's going to be injected into the marketplace to get a better return. Government will try to do things to slow this process, but it's going to happen. And so over the next decade to decade and a half, you're looking at 9.23 trillion in circulation, okay? Versus where we're at now, 1.23 trillion, right? Which gives us a jump, to make the math real easy, about 7.5 times. So that's what your inflation is going to look like over the next 10 to 15 years, all right? So what's that going to do to your house prices if it's a hard asset? There's some people saying that your house price over the next 10 to 15 years is going to go up 400 to 700%. Okay. Now wait a second. That's crazy. That's crazy. That's never happened before. No, my brain doesn't go past 1990. All right. Well, your brain does go past 1990, which mine does, even though I wasn't born back then. Got papers everywhere, charts. I'm a mess. I need to get some PowerPoint or something. What do you think? All right. So this is going on. Has this ever happened before? Oh my gosh. Let's look at 1970. All right. To 1980. Let's look at interest rates. All right. Interest rates were 4.5% in 1970. You guys remember what they were in 1980? Really high, okay? 21%, all right? Nobody's gonna buy houses. We're gonna have another crisis. Okay, unemployment. People aren't gonna be employed because of all this stuff. The unemployment rate's going up. You're right, it is. In 70s, 3.5% unemployment, not bad. Rose to 10.5% unemployment. Okay, by 1980, that was crazy, right? Huge. So got high unemployment, high interest rates. But we were printing money. Okay, we went from less than 10 million to over, 16 to 20 million by a day by 1980. All right, now we're doing over 3 billion a day, so it's a lot. All right, inflation was almost zero here. Okay, but that rose tremendously to 1980. And if you bought a house in California for like 50 grand before 1975, you were selling that house for almost $500,000 in 1981, 1982. All right. So supply, demand, inflation, printing money, these are the reasons that the housing market is not going to crash again because of interest rates. You guys understand that? Mm-hmm. It didn't do it then, so it's probably not going to do it again. So what does that mean? What does that mean for you? All right. What it means is that if you got to make moves in real estate, do it now. You probably should have did it last year, but do it now. Okay. If you're going to upgrade your house, do that now. If your kids are going to buy a house within the next 5 years, buy it now. Buy it as an investment for them. Because this is going to continue, it's an asset that's going to continue to rise, all right? It's been stagnant for 10 years now, almost, right? And real estate has, remember when they lied to us and they said that real estate never goes down? And that's a whole nother thing. I'll tell you about that later. But that's because, anyways, different locations were offset by a couple of years, and so they were selecting the data. But anyway, it's another thing. But point is, real estate goes through a cycle. We've just gone through a bear cycle for what, a decade? Don't you think that it's going to go up again? And can't you see how that is? So now is when you have to move and do that stuff. You're going to talk to your financial advisor. You're going to get advice so you do the right thing. And now is when you make moves in real estate. If you're going to invest in property, buy it now, okay? If you want to upgrade, even on a downgrade, but if it's like a new construction or whatever, I mean, now's the time to make the moves. And then you hold that asset for the next decade, decade and a half, because you're about to see an increase in that investment, okay? And that's all I got. Now, just last quick stuff. I put stuff on my team. What's on your tables is really what I do. I don't do this, obviously. Okay. Let's be serious here. What I do is I list property. I get it sold for top dollar. If I'm representing you as a buyer, we get the best price for the house. That's what I do, and that's what that package is about. Okay. And so when it's the right time for that, you can look at that stuff. If you need a works cited, if you want more info for what I'm talking about, any of that stuff, shoot me an email or whatever. I'll dig it out. Like I said, I just had notes. So, you know what I mean? Get in touch with me. I'll give you guys actual data or, actual resources to look up and stuff. So that's all I got. You can go eat now. All right, thanks.